In the early 1500s, sailors stepped onto a coastline so vast it felt unfinished. Jungle thicker than walls, rivers wider than seas, and beneath the soil, more wealth than anyone could measure. Portugal called it Brazil. For centuries, Brazil didn't just get rich. It struck gold, sugar, diamonds, coffee, rubber, oil, iron. Or, every era, a new treasure, every generation, a new boom. And yet today Brazil is not a rich country. It's the world's ninth largest economy by size. It exports jets, soybeans, crude oil, iron ore, beef, coffee. It has deepwater oil reserves and some of the largest freshwater supplies on Earth. It is home to over 200 million people and one of the biggest consumer markets in the world. So what happened? Because Brazil didn't just get rich, it got rich in cycles, and cycles can be dangerous. Right now, in a world scrambling for food security, energy, and critical minerals, Brazil matters again. China needs its soy, Europe needs alternative energy partners. The world wants iron for infrastructure and oil for stability. Brazil looks perfectly positioned. But that's exactly what people said before. Let's rewind. The first fortune was sugar. In the 16th and 17th centuries, Brazil became the world's largest sugar producer. Vast plantations powered by enslaved labor made Portugal extraordinarily wealthy. Sugar was the oil of its day, and Brazil was the Saudi Arabia of sugar. Then came gold in the 1690s, massive deposits in Minas Gerais. So much gold flowed to Europe that Lisbon rebuilt itself in Baroque grandeur. Then coffee in the 1800s, Brazil produced nearly 80% of the world's supply at one point. So Paulo exploded into a financial center. Railways expanded, banks multiplied, every time the same pattern. A commodity rises, global demand surges, Brazil becomes indispensable. Money pours in, then prices fall, and the bill arrives. The problem wasn't that Brazil lacked resources. It had too many easy wealth changes behavior. Governments borrow more, elites protect their advantages, industry gets neglected because why manufacture complex goods when the world pays you handsomely for what comes out of the ground? Economists call it the resource curse. Brazil lived it. In the 20th century, the country tried to break the pattern. After the Great Depression crushed coffee prices, leaders realized dependence was dangerous. So they built factories, steel mills, car plants, state companies under President Vargas. Brazil embraced industrialization. The government protected domestic industries with tariffs. It created national champions. Later, during the military government from 1964 to 1985, the state doubled down on heavy industry and infrastructure. For a while it worked between 1968 and 1973. Brazil experienced what was called the Brazilian miracle. Growth averaged over 10% per year. Highways expanded, hydroelectric dams rose from rivers, cities modernized. But miracles funded by debt are fragile. The oil shocks of the 1970s hit hard. Brazil imported most of its energy at the time. To keep growth alive, the government borrowed aggressively from foreign banks flush with petrodollars. Debt piled up. By the early 1980s, interest rates in the United States surged under Federal Reserve Chairman Paul Volcker. Suddenly Brazil's dollar-denominated debt became crushing. The country couldn't pay, inflation spiraled, then it exploded. At its peak in the early 1990s, inflation in Brazil reached nearly 2,500% per year. Prices changed daily, sometimes hourly. Supermarkets hired workers just to relabel shelves. People rushed to spend salaries the moment they were paid because tomorrow the money would be worth less. It's hard to build a rich country when your currency evaporates in your hands. The turning point came in 1994. The real plan, under Finance Minister Fernando Henrique Cardoso, Brazil introduced a new currency, the real. But this wasn't just a currency swap. It was a carefully staged stabilization strategy. The government cut spending, reined in deficits, and temporarily anchored prices to a stable unit of account before launching the new money. Inflation collapsed, stability returned. For the first time in decades, Brazilians could plan beyond next week. Then something remarkable happened. In the 2000s, the world changed again. China industrialized at breathtaking speed. It needed iron ore, it needed soybeans, it needed oil. Brazil had all three. Iron ore from Vale-fed Chinese steel mills, soy from Mato Grosso-filled Chinese ports, offshore oil discoveries in the pre-salt fields turned Brazil into a rising energy power. Between 2003 and 2011, Brazil grew fast. Poverty fell sharply, tens of millions joined the middle class. The government expanded social programs, like Bolsa, providing cash transfers to poor families conditional on school attendance and vaccinations. It looked like the formula had finally been solved: stable currency, strong exports, social mobility, democratic institutions. Brazil was invited to join the BRICS group alongside Russia, India, China, and South Africa. It was marketed as a future superpower. Then commodity prices fell again. From 2011 onward, China's growth slowed. Iron ore prices dropped, oil prices crashed in 2014. Government revenues shrank, but spending expanded during the boom, remained high. The math turned ugly. Brazil entered its worst recession in modern history between 2014 and 2016. GDP contracted by about 7% over 2 years, unemployment surged, public debt ballooned, and then came the corruption scandal. Operation Car Wash uncovered massive bribery schemes involving the state oil company Petrobras, construction giants, and politicians across the spectrum. Billions had been siphoned off through inflated contracts. The irony was sharp. Petrobras had been the symbol of national pride and energy independence. It became a symbol of systemic corruption. Presidents were impeached, political trust collapsed, investors fled. Again, a boom followed by a reckoning. So how did Brazil get so rich? By being essential over and over again. But essential for raw materials. Today, Brazil is the world's largest exporter of soybeans and coffee, one of the largest exporters of beef and iron ore, a major oil producer. It has a sophisticated agricultural sector that uses advanced technology, satellite mapping, and genetically modified seeds to maximize yields. It also has Embraer, a globally competitive aircraft manufacturer. It has a large banking sector and a dynamic fintech scene. Its stock exchange in São Paulo is one of the largest in the developing world. This is not a simple commodity economy, but commodities still dominate the trade balance. When global prices are high, Brazil looks unstoppable. When they fall, fiscal pressure builds quickly. Here's the uncomfortable mechanism. Brazil's government spending is rigid. A large share of the federal budget is locked into pensions, public sector wages, and mandatory transfers. Adjusting quickly during downturns is politically painful and legally difficult. Meanwhile, tax rates are high and complex. Businesses face layers of bureaucracy. Productivity growth is slower than in many peer countries. So growth depends heavily on external demand. When China buys more soy, Brazil grows. When China slows, Brazil tightens. It's leverage without obvious leverage. There is also geography. Brazil is continental in size. Transporting goods from interior farms to coastal ports is expensive. Infrastructure gaps raise costs. Investment helps, but investment requires confidence, and confidence swings with political cycles. And politics in Brazil is famously fragmented, dozens of parties in Congress. Coalition building is constant negotiation. Reform is possible but slow. Yet here's the paradox. Despite all this volatility, Brazil has built durable strengths. Its central bank is now independent. Inflation, while still present, is nothing like the chaos of the 1990s. The financial system is relatively sophisticated. The agricultural sector is among the most productive in the world. The energy mix includes a high share of renewables, especially hydropower and biofuels. Brazil is not poor because it lacks capability. It is vulnerable because of structure. The world is entering another resource-hungry era. Energy transition requires iron, nickel, and other minerals. Food demand continues rising, climate change reshapes agricultural maps, and Brazil still has arable land reserves compared to many countries. That sounds like another boom. But the deeper question is whether Brazil can turn commodity windfalls into lasting productivity gains. That means better infrastructure, simpler taxes, educational improvements, more innovation, less political fragmentation. It also means resisting the old temptation: spending as if high prices will last forever, because they never do. There is a quiet skepticism embedded in Brazil's history. Every generation believes it has finally escaped the cycle. Sugar felt permanent, gold felt transformative, coffee felt unstoppable. The China boom felt historic, each was real, none was permanent. And yet Brazil endures, it stabilizes, it reforms, it booms again. So perhaps the better question is not why Brazil isn't rich yet. Perhaps the question is whether the next boom will finally fund something that doesn't depend on a boom at all. Because Brazil has already proven it can get rich. The unresolved part is whether it can stay that way when the ships stop coming.